Good day traders, Richard here doing quick Ichimoku cloud chart trading review as well as artificial intelligence trading review using the Fulgent AI engine and looking at Apple in this case. We have had some really great volatility breakout signals the last couple of months using the Fulgent AI engine. Now let's take a look at the most recent signal there. In the last Apple update, I was looking at this breakout past the top end of the cloud here, and then highlighted that Apple could consolidate back down to test this top end cloud chart support zone, the top end of the front end of the cloud chart support zone, and the bottom end of the front end of the Ichimoku cloud. So these are the downside risk targets, those three, that zone there, this one, and this one, 256, and then we got there very close to the exponential moving average there, and then we have now a nice volatility breakout signal there. So it reached our downside targets as expected, the price action, and now we have a new volatility breakout signal there. It needs to get past this resistance zone there, 265, as well as the top end there, and we'd like to see price action way above the top end of the cloud here to be really fully bullish on price action above the Ichimoku cloud. Price action above the cloud is bullish, price action below the cloud is bearish from an Ichimoku cloud chart perspective. Just look at key support zones. There's another one down here, so we could see that might test that one, 251, if these resistance levels hold to the upside. But so far so good. Nice new volatility breakout signal there. Let's take a look at the weekly Ichimoku cloud. Weekly, lots of volatility. We could see it, some great volatility breakout trades here. Still trading a little bit extended from the top end of the cloud here. Watch out for the top end of the front end of the cloud. These support zones to be tested there. 258, basically 260 there is a major support zone. So it looks like Apple is rebounding there, and if we zoom in closer we can see that it's also a strong rebound here from the standard line of Ichimoku cloud. So that's another swing trade entry point on the weekly Ichimoku cloud, but still some downside risk. We could easily, in a very weak market, dip back down to 238 and the bottom end of the front end of the cloud. So these are the downside risk targets for the next couple of months on the weekly Ichimoku cloud. But so far the rally should continue if we find support at this standard line of the Ichimoku cloud, that zone there, 256, and the top end of the cloud. So as long as we stay above those levels, we should avoid this kind of consolidation to the downside. But back to the daily, watching very closely, the catalyst is for a breakout past this 265 zone, and then the next upside target would be this old cloud chart resistance zone, 272, and then once again these old highs, the top end of the cloud. So these are the upside targets for this volatility breakout swing trade, provided we manage to stay and break out past and stay above the top end of the Ichimoku cloud. But watch very closely for the interaction here with the resistance here on the Ichimoku cloud. Turning to the star mine data, the multi-factor model incorporating thousands of data points, looking at the income statement, drivers of growth, credit risk, all those type things, valuation. So far the bullish arguments here, the price momentum rank is still highly in the top 20% of the market. ARM score is 90, so the analysts are upgrading and revising their numbers to the upside. Smart holdings, the smartest fund managers out in the room, are holding the stock, so it gets an 88 percentile rank there. Short interest is 97. There's really not much short interest in the stock. And the earnings quality rank is 97 percentile rank, so it's outperforming 97% of the companies in the database based on the earnings quality. Not much credit risk, combined credit risk 95 percentile rank, so the company's got sufficient cash flows to pay for its AI expansion. It's not an M&A target. Insiders are still selling consistently, so that's one risk factor. But the main drawback right at the moment is the intrinsic valuation and relative valuation. Percentile rankings there of 13, so it's in the bottom 13 percentile of the market. So you can see here how the stock is quite a premium quality company, very expensive based on all these valuation metrics. One thing that's interesting, if we scroll down here and we look at the market implied growth rate, the current, that's where we use the data, the estimates going forward of the smartest analysts, most accurate analysts, and we then do a reverse discounted cash flow analysis DCF basically, and we input the stock price and tells us, and then inputting the stock price, we then estimate what the market implied growth rate is that the current stock price is implying. And if we can see from here 15% growth over the next 5 to 10 years. 5 years they're assuming 17% growth rate, and then from the year onwards long-term 12, so it looks like it's about a 15% growth rate per annum over the next 10 years that the current stock price is implying. So that's not too bad considering the excessive valuation rankings here that Apple is going through. But thanks for watching. Until next time, happy cloud chart and AI trading. Bye for now.